Oh, Kees, it's very nice to see you. I'm assuming that you're on lockdown at the moment in New York.
Yes, well, New York, I'm in Connecticut. I've not been in New York since about 8 months now.
Oh my, it's just
Yep.
a totally different world these days.
Exactly, yeah, it's something quite different.
So when you're talking to people, what's keeping businesses awake these days relative to their operations in Europe from a tax perspective?
Yeah, well, Rod, one of the things that keeps people awake and worried, and even more once they realize what it entails, is ATAD2. And ATAD2 is just one in a series of measures that both the EU and OECD have taken to combat perceived tax abuse. ATAD2 is about hybrids, anti-hybrids. So basically, it's aimed at putting an end to all the stuff that made being a tax advisor fun, right? All the double dips, triple dips, deductions, non-inclusions, deductible dividends. All that stuff is targeted by ATAD. So as such, that's of course not that much of an issue, but on the circumstances there is unintended and unperceived overkill, and that may have very nasty consequences, and that's what we talk a lot about with our clients these days.
And so as you talk to clients, what sort of, I mean, it's a brave new world for a lot of people, what sorts of practical pointers or pieces of advice or general things are you talking about the most, would you say?
Yeah, so ATAD2, typically it's aimed at situations where you either have a double deduction of expenses or where you have a situation of a deduction on inclusion. So, and you will run into that in situations where a US company has a directly owned EU subsidiary that is checked as transparent. And a lot of transparent checking has happened after US tax reform, and that had to do with BEAT and what have you. So if you have a service entity in Europe that renders services for the US and is checked as transparent, typically the US will give sort of a cost plus remuneration for that. Because the entity is transparent, all the expenses of the company are deductible at the local level, and because the entity doesn't exist in the US, also in the US, so you're squarely within these ATAD2 provisions. And then, of course, the disaster strikes if the US makes a cost plus payment to the directly company, because at the local country, that cost plus is included in income, but there is no dual inclusion of income because that payment is not seen in the US. So on one hand, you have a double deduction of all the expenses, and on the other hand, you don't have an escape that applies if you have dual included income. So that's a situation where a lot of our clients run into. And to complicate it, the ATAD, it's a directive. So that's basically rules issued by the EU, and all the EU countries have to comply with it. So as of January 1st, 2020, all the EU countries should have implemented the ATAD legislation. And the thing is, they have to implement everything that is in the directive, but there may be variations. Some may be more strict, some may be less strict. And that sort of makes it a smorgasbord of potential pitfalls if you have such a situation. So I guess our message to clients is typically, if you have a directly held EU subsidiary that is checked as transparent, talk to your tax advisor, because there may be unintended drawbacks, and it can be pretty dramatic, right? Because if you have the example we just had, an EU company that renders services for the US and gets a cost plus, and because the cost plus is not a qualifying inclusion, the local company may lose a deduction of all its expenses, and that will mean that the cost plus it gets from its parent company would fully constitute domestic taxable income. And that is, to give an example, if you have 100 of expenses and 105 cost plus. So your commercial income is only 5. But because your 100 is not deductible, all of a sudden your taxable income is 105, and your tax, let's say, at the rate of 20%, maybe a little bit over 20, whereas you only have 5 positive cash flow. So that shows that that's a situation that you really want to avoid and be aware of. So that's what a lot of the work we're doing at the moment, and of course there's ways to work around it and to avoid it. But I guess if there's one message we have for our clients, it's beware if you have a directly checked EU subsidiary.
Well, that's really good advice, Kees. So easy to understand what these rules are aimed at, and they came into force January 2020.
Correct.
So I guess if people haven't been looking at it, the message is certainly, particularly given that sort of example that you shared, this could have significant unanticipated tax exposures, and talk to your local advisor.
Exactly.
Well, no wonder you keep me so busy, Kees. Look, it's really nice to catch up with you, and I look forward to seeing you in person sometime when we're flying again soon.
I'm looking forward to it. A pleasure as always, Rod. Take care.
You too, Kees.